Every year, average around 6+% per annum in dividend yields. So his current stock portfolio is in Bursa Malaysia as well as SGX. Okay. So Mr. Ian Tai, let's all welcome Mr. Ian Tai.
Yay, hi. All right. First and foremost, thank you so much, Smita, for a while. Sorry. I'm also getting a little bit excited over here. Thank you so much for the introduction. All right.
Welcome.
And it's a privilege of mine to be here today to actually present what I've been doing on almost on a daily basis. All right, to you guys. So today we're going to talk about stock valuation. All right. So basically, this is a very important topic when it comes to stock investing.
Mm-hmm.
All right, because you can't do stock investing without knowing how to value a stock. All right. So without further ado, I have actually prepared a lot of contents for you guys. And before I begin, if you have a smartphone, all right, and you have a calculator app, because we are doing valuation, means to say it has a lot of numbers and figures. But don't worry, it's not very complicated to do. But it's very helpful that if you have a calculator beside you or the calculator app, all right, beside you when you actually go through this particular series. All right.
Okay.
All right. So without further ado, let's begin. All right. What's my first part? Okay. So part number one, we are going to talk about how do we achieve consistent results in stock investing. So let me press the clicker. Okay. So let's start with something a bit lighter before we get into something more technical. All right. Today I'm going to share with you a little bit about the Pareto principle, or usually it's more commonly known as 80-20 rule.
Okay.
Okay, I'm not too sure whether you heard this before or not. All right, so I did a little bit of research on this Pareto principle, and it is actually named after an Italian economist called Mr. Wilfredo Pareto. So therefore, the Pareto principle. Okay, so basically there are a lot of usage when it comes to this particular principle, and it's actually stated on the screen here. So initially it was actually used for economics, meaning to say, like for example, in his case, it states that 20% of a population actually owns 80% of a country's wealth.
Oh, okay.
Yeah, all right. So that is basically his findings. But sooner or later, more and more people tend to use it into other areas of life. Like for example, time management. Like for example, like some people may say, actually 20% of what you do actually gives you 80% of the results.
Oh, okay.
Something like that, all right? And of course, when it comes to business, some people say the top 20% of your customers tend to give you the best 80%, the best, not to say the best, I mean, it accounts for 80% of the revenue or the profits, something like that, all right? Not too sure whether you can relate it lah. Of course, when it comes to sports, like for example, if you play, let's say, badminton or tennis, world rank number 1 player and world rank number 20 player, huge difference, right?
Yeah.
All right, they are both good players, but somehow when you put these two together, it seems like, how come one is like a master and the other one is like, he just learned how to play badminton yesterday. So it's that kind of 80-20 rule, and it also applies in stock investing. All right. So with that, I have actually dived in because for me, I have been quite interactive with my subscribers, my readers, and of course, webinar listeners on the subject of stock investing. How do they invest, and what causes them to actually invest and achieve their kind of results? That is something which is to my interest. Okay. I mean, say, how do they actually get that kind of results?
Yeah.
All right, which is something to me is also a form of study. Okay, I'm interested to know about this. So basically, I found that usually when it comes to achieving consistent results, right? What happened is this: a lot of people may not actually achieve consistent results especially when it comes to stock investing. Some of them say, sometimes I make money, sometimes I don't make money, right? Sometimes I make so much profit, but then the next stock I lose it all. All right, it's actually quite common. So what are the common traits? So basically, I have actually pointed out this to you, pointing out on the screen. So not too sure whether you are agreeable or whether you find this familiar to you or not. All right, a lot of people tend to invest based on the following. For example, many people tend to follow, maybe they have lunch or coffee with their friends or relatives, and then the subject of stock investing comes up. and then they start to talk about certain stocks and stuff like that. And that actually, how would I say, ignited the interest. Hey, there's such a stock. Okay, then I go and find out more about it. So it's actually very ad hoc. That means before the coffee session or before the lunch session, you may not know it may not occur to your mind that, hey, I should actually invest in ABC stock or something like that. But then because of the coffee, now you want to actually get into it already. So most of the people tend to actually have this kind of way. That's how they get into the stock.
Yeah.
And of course, some of them, they tend to read the newspaper. Maybe they read, let's say, The Edge. Then, not to say The Edge is no good. Actually, I also do read The Edge or any, like for example, or any other publications. Right? Maybe they have headline news. Like that. Okay, this stock like that. Okay. Then they start to find out. It's only through reportings or brokers, even brokers reports. They find all these stocks and then they start to actually invest in them. Not too sure whether you buy stocks based on all this kind of method. And another common trait that I find is that most people, when they buy stocks, they do not know what they are getting into. What do I mean? For example, if you ask people, okay, let's see whether it applies to you or not. If for the last stock that you purchased, doesn't matter what Maybank or AirAsia or whatsoever, can you actually tell me what is the how much did the company make? How much profits did they make for the past 5 to 10 years? Most people would say, don't know how much? So people buy stocks, but yet they do not know how much profits the company is actually making. All right. So most of them have that kind of thing. So I'm not too sure whether that's you or not. All right. So let's keep it as it is. The third reason is education. Okay.
Just 1 minute again. Now we're getting some feedback that the slides cannot be seen.
Slides cannot be seen.
Yeah.
Oh, like that lah. So what do I do now?
Okay, just 1 minute. We'll just see.
Or I just keep talking and then don't worry lah. I'm just telling stories lah. All right. So let me just continue on. So usually what happens is that the third reason why how people get into stocks is because they're interested in the profits. But yet, when you ask them, have you attended any seminars or workshops and books and stuff like that? So maybe they read some books, maybe they bought some books, maybe they attended some webinars or seminars, or maybe they read a blog, but then it wasn't actually enough. So it's actually a good thing that you guys are here because by being here, you are positioning yourself to be in the 20% group lah. So congrats to you when it comes to that. Okay. Now I'm going to review to you what the 20% actually does.
Okay.
All right. So that you can avoid what the 80%, the mistakes that the 80% made can be actually easily avoided. So I'm going to share with you what the 20% actually does. Okay. So basically, to sum it up, all right, what I would like to advocate to you is this. When it comes to stock investing, most people do it on an ad hoc basis. Means I think of a stock, then I buy, right? But usually for the 20%, we always do it with a system, all right? So a system is very important when it comes to investing. Doesn't matter what you invest, properties, stocks, or even if you're into business, it's very important for you to have a system, okay? Now, when it comes to stock investing, just bear in mind that there are always, for stock investors, not traders. Trading will have another set of rules. I don't trade, I'm an investor. So when it comes to systems, it's very important for you to have these 3 systems in place in order to achieve consistent results. The first one here is the system where you assess the quality of a stock. Like for example, in Bursa Malaysia itself, we have about 900 plus stocks listed on Bursa Malaysia, but not all of them are good. All right, there are some are good, there are some are bad, right? Some are profitable, some are not profitable. So you need a system in place to actually separate what are the good ones from the bad ones. That one you need to read annual reports and quarterly reports to find them out. So you need to have a system to separate good from the bad. That's the first one. Then After that, after you have set up the first system, then we have system number 2. Now you have a pool of good stocks, right? The bad ones you don't need already because not exactly suitable for investment.
Yeah.
So now you are left with the good ones. 900 good ones, but none of them are cheap, right? So value investing is about buying undervalued or cheap stocks. All right.
Okay.
Okay. So what we need is a system, which is today's webinar. How do you actually separate the expensive one from the cheap one, so that we can actually narrow down to the cheaper one? So that is what we are going to look at today. And of course, the final one is that from that cheap stocks, all right, then we have portfolio management techniques. Meaning to say, when you have a pool of money to invest, all right, how much do you actually buy? If you are given like 100,000 to invest, do you dump it everything, or do you actually split it? How do you split it? All right, and after you have invested, okay, here's the thing. Most people who actually buy it on an ad hoc basis, they track their results on an ad hoc basis. But for investors, especially the 20% one, they tend to track their results. They want to see where they have come, their progress and stuff like that. So that's very important. And of course, a system must be in place, because when you buy a stock, prices may go up.
Yeah.
Prices may also come down, right? Prices may also go sideways, right? Nowhere, right? So in all these 3 scenarios, we have a system in place for investors to react. All right? Because without the system, you are investing without certainty.
So you're just investing blindly.
Blindly lah.
Okay.
Means if you do not understand whatever I've mentioned, at the end of the day, you just need to remember one thing. Investing is about systems. All right? If you don't have a system, don't invest. That's as simple as it is, right?
Okay.
With that, I've actually covered the theory. The next, I do not know, 50 minutes or so, we are going to do the technical and the practical part. So now I would like you to participate with me. Maybe we can check out the polls and stuff like that. So it's game time. Which of the 2 stocks would you invest into? Okay, so this is actually a game. So hopefully you guys are participative. Now let's move on. Let's start with the first one, yeah?
Okay, let's start.
Okay, now I'm going to give you 2 stocks. Stock A and stock B. Stock A is priced at, the share price is trading at 1 ringgit. Stock B is actually trading at 10 ringgit. Now, which of the 2 stocks would you invest? Or which of the 2 stocks do you think is cheap? All right, so you may actually put your comments in the chat box, right?
Yeah, a lot of people are answering stock A.
Stock A, yeah? Okay, so are there any further information? Any further feedbacks from the people?
Depends. Some people are saying depends on the PE ratio. Too little information to decide. Depends on the fundamentals of the stocks. B. Some actually said B is too expensive, and some actually say there's not enough info to know which is the cheapest stock.
Okay, so we can say that out of 10 people, 6 or 7 people may say stock A, right? And then there will be 1 or 2 who say stock B, just to see whether I will come out with something new, all right? And there are some people who say not enough information.
Yes.
For me, the right answer is not enough information. So for those of you who have actually answered that, that is basically the correct answer.
Not enough information.
Not enough information, correct. So a lot of people, they tend to invest in a stock because they see the price. They do not know what they are getting into. They only see the price. It's like buying a property, say, 2 properties. 300,000 and 500,000. Which one is cheaper? Then a lot of people say 300,000, right? But they never ask what's the per square foot of the property. Is it a big property or a small property? So that is the purpose of doing valuation. All right, which is actually basically this slide here. So for me myself, I cannot decide, and this is why we do stock valuation. Okay.
Okay.
Now, there are basically, I'm going to talk about 4 valuation tools, all right? So it depends on which one is more to your liking. Okay, so basically there are 4. The first one is PE ratio, or price to earnings ratio, which is where you compare the stock price against its earnings per share. The second one is PEG ratio, or PEG ratio, which is price to earnings to growth ratio. That means to say, after you have calculated the PE ratio, we will compare it with its growth. The third one is price to book ratio, or PB ratio. That one we would like to compare the stock price against its book value. All right, so its book value is basically the shareholders' equity divided by numbers of shares. Okay. The fourth one is actually dividend yields, whereby we are going to compare the stock price against its dividend payouts. All right. Now I'm going to go into each and every single one of them in greater detail.
Okay.
Now I'm going to give you new information. Okay. Now tell me, which of the two stocks itself is cheaper? Is it stock A or is it stock B? Now stock A, the price is actually $1, earnings is 5 cents. Stock B, it's the price is $10 and the earnings is $1. All right. So guys, which of the two stocks do you prefer to invest?
Okay. People have already answering, and they're all answering stock B.
Stock B, right? So there's no one saying stock A, right?
No, no one is saying stock A.
All right. So that will make my job easier lah. Hey, got one stock A.
Yeah, there's one person who answers stock A.
Okay. Now, all right. So for most of you, I believe you have actually understand the concept, but there's one that we need to actually explain lah. All right. So I'm gonna dish out my explanation. So basically, it is very you can't look at price alone. The first reason. So basically, what we do is that one of the things that I do is we actually calculate the PE ratio of a stock. So price to earnings. All right. Why do I calculate that? Because first and foremost, 900 stocks in Malaysia, some of these stocks don't even have earnings. Then you shouldn't invest in them lah, all right? So you want to invest in profitable companies, right?
Yeah.
So therefore you look at its earnings. Now, stock A, if you look at PE ratio, you take $1, you divide it by 5 cents, therefore your PE ratio is 20, all right? That means say for every dollar, you're willing to pay 20 ringgit to invest in a company that is making $1 lah. Okay. For stock B, the PE ratio is 10 divided by 1, which means for every dollar the company earns, you're willing to invest $10. Okay. So basically, stock B is cheaper in that sense. Okay.
Okay.
Simple, huh?
Yeah.
Move on. Why stock B is cheaper? Okay. So basically, this explains it all. So personally, for me, I will aim for stocks which are of lower PE ratio. Okay, so a high PE ratio, if a stock is actually trading at a high PE ratio, that means it's more expensive and more overvalued. That means the deal is less attractive. Whereas low PE ratio means it's cheaper and more undervalued. All right, this one is very simple.
Okay.
Now let's play on. Let's add new information. Now I'm going to give you two stocks. Okay, it's the same stock, but for stock A, right, I have actually calculated that the earnings growth rate for the past 10 years for stock A is 25% per annum. That means say it could be a stock where it made 100 million in 1 year. The next year it made 125 million. So it jumps 25% on a per annum basis. Whereas for stock B, for the past 10 years, its earnings are growing at a rate of 5% per annum. That means this year they make 100 million. Next year they make let's say 105 million. So there's still growth, but not as much. Okay, so guys, which of the two stocks do you think is cheaper?
Okay, people are answering stock A.
People are
Yeah.
Stock A.
1B.
1B.
Stock A.
Okay. All right. Fair enough. Okay. So here's my personal view when it comes to looking at these two stocks. Okay. Now, obviously, we're going to have this calculation. Let's take a look at both stocks, A and B. Now, when it comes to A, it has a PE ratio of 20. All right. And when it comes to B, the PE ratio is 10. So what happened is that it seems that initially B seems to be cheaper than A, right? But when we actually factor in growth, okay, what we do is that we take the PE ratio, which is 20, all right?
Okay.
Now it's a good time to actually use the calculator, all right? If you have a calculator beside you, if you have a PE ratio of 20, and then we go back, we divide it by the 10 years earning growth rate of 25% per annum. So 20 divided by 25, you should get 0.8. Whereas for B, you take PE ratio of 10 and you divide it by 5, therefore you get PE ratio of 2. Okay, so which of the two stocks is cheaper? Actually, it depends, right? It depends on which of the two ratios do you prefer to use.
Okay.
That means to say there's no right or wrong answer for this one. Okay, depends on what you are looking at. Okay, but for the sake of explaining what is the PEG ratio, I'm going to just state the formula here. So if the stock is growing, always aim to find a stock where the PEG ratio is lower. All right, the formula is as stated, PE ratio divided by earnings growth. Now, according to the formula, if PEG ratio is more than 1, that means the stock is expensive lah, mahal, and it's overvalued. Whereas if the PEG ratio is below 1, then it's cheaper and more undervalued. Okay? But to compare the two, to put the two side by side, stock A, I would say stock A is cheaper if, all right, in terms of if we look at earnings growth. Okay? Now, when it comes to stock B, it is cheaper if you base on today's earnings. That means I'm investing in something which is today. I want to see money today. If you are that kind of person, actually usually I am lah. So I will, for me, right, I may actually go with stock B. There's no right and wrong answer. But another friend of mine is more into the growth prospects of a company. That means he wants to see, stocks like, let's say, Alibaba or Tencent, good growth. China, the market's so huge, right? You can keep on getting more and more internet subscribers. Then they may want to look at earnings growth. But if you are the stable type, let's say, public bank, or what? Actually, by the way, all these stocks that I mentioned, right, it's not actually a recommendation lah. All right, I'm just illustrating. Let's say public bank, it grows on a steadily basis, then you may want to go into stock B. So stock A, let me just go into the theory. Stock A is for you if you are interested to invest in a fast-growing business, all right, whereby whatever the company made, that means every dollar the company receives in cash, it will actually dump in more into investments. That means if it has three restaurants, not three lah. I mean, if let's say it has 300 restaurants, next year they say I want to hit 400 restaurants, 500 restaurants, 600 restaurants. It seems like very exciting. So rapid expansion. So if you are that kind of investor, it's best for you to read the chairman's statement.
Okay.
And find out what the company, the managers, what they are trying to do with your money in the future. That one is very important. Whereas if you are the stock B kind of person, then you assess the company's business model, whether or not it's stable or not.
Okay.
Okay. So you assess it because of two reasons. Number one, you want it to continue to grow slowly. Number two, of course, when you invest, there are times that we need to prepare for economic crisis, right?
Okay, there's a question here that someone asked, why read the chairman's statement to prospect?
That one is very important. That is one of the most important things that you need to read, because when you invest, the company, let's say the company receives your cash or something like that, it has to do something, right? So you want to, you want to know what the company is going to do with your money. Okay, if not, why invest, right?
Yeah.
Like for example, now a stock has 10 manufacturing plants. So what are they going to do with your money? Are they going to stay after 5 years later having the same 10 manufacturing plants, or are they gonna set up a plant in another place, set up, because more factories, more income. Then you invest, right? So that is where growth comes in. That's where your capital appreciation comes in.
Okay.
You can't tell that with just financial statements, all right? But you assess the business model of the company so that it's resilient against economic crisis. That's very important to me, all right? Okay. Because it's not about making money. It's about investing safely.
Okay.
All right, let's move on. I believe you have all kinds of questions, right?
Yeah.
if you have questions, just put it in. We will actually address them lah.
Yeah.
We got half an hour to address them, right?
Yes, we have half an hour later, towards the end, to address them.
Okay, I will make it quick, right? Okay, third one. All right. So we have covered PE ratio, which is a comparison against earnings. We have the PAC ratio, which is PE ratio against growth. Now let's move on to the third one. Two stocks side by side. One is at $1.20. The equity is 30 cents. Stock B, 12 ringgit. The equity is 15 ringgit. So which of the two stocks do you think is cheaper? Okay.
Okay.
Now, equity means like, for example, me and Smita, we decided to open up a shop, a retail shop, and then we put in 50,000 each into the shop. So the shop is, let's say 50,000 each. So that means our capital is 100,000. All right. 1 year later, let's say it made another 100,000. So that is equity, which is 200,000. Okay. So why is it different from the price? Let's say our friend here, Chun Xian, he's rich enough to buy up our retail shop. He's willing to put in 400. He's willing to buy us out at 400,000. Isn't it good?
Yeah.
All right. So that means we put in 100,000. We made 100,000. So actually the equity is 200,000, right? But Chun Xian is offering us 400,000. So is it twice the amount?
Yeah.
So that is PB ratio.
Oh, okay.
Right? So which of the two is cheaper?
Okay, some answer stock B, some answer stock A. One person actually said not enough info, but we're getting most answers are B.
Okay, so basically I didn't want to play mind games over here lah. It's actually a basic calculation. So the answer is actually stock B for now, all right? And this is to illustrate how do you calculate PB ratio. So PB ratio is calculated like this. You take the price, you divide it by the equity, like stock A, $1.20, you divide by 30 cents, and your PB ratio is 4. Whereas for stock B, although it's priced at 12 ringgit, but the equity is 15. So therefore, 12 divided by 15, you're supposed to get 0.8. So therefore, stock B is cheaper than stock A. In that sense lah. Okay. So I think most of you get it, all right? So just be patient. I know what I'm presented so far for some is actually very basic, all right? But we'll get to the technical one, really, really interesting one later, all right? Of course, high PB ratio means expensive, low PB ratio is cheap and undervalued. Okay, now we move on to the last one, which is the dividends. Now we are comparing price against dividends. Now don't take it like so far out, all right? Just based on these two information, which of the two is actually cheaper? Maybe Smita, you can actually answer in 30 seconds time. All right, so we have stock A. I'm just going to read out. Stock A, the price is 5 ringgit 85 cents. And you found out that the dividend per share is about 29.3 cents. All right, which is 0.293. Whereas for stock B, the stock price is 2 ringgit 89 cents, and then the dividend is 7.2 cents. So which of the two is actually cheaper? So what do we have?
Okay, a lot of people are answering stock A. Stock A is cheaper.
Stock A is cheaper. What do you say? Or do you need a calculator?
I would say stock A as well.
Stock A lah, right? Okay, most of us are getting stock A, right? One of them says depends dividend stable or not. Okay, that's a very good point. That one I will be bringing out later. All right, all right, because it's very important. So the answer for now is stock A. So if you can see, dividend use is like this. We always calculate dividend use of a stock. Okay, actually dividend paying stocks are actually very good because number one, it signifies that the company has cash.
Oh, okay.
All right, no cash cannot pay you dividend. Then invest for what, right? That's the first one. Second reason why some companies tend to pay every $100 they make. All right, maybe they pay $20 in dividends, but then they keep 80% for investment. So why why find dividend stocks? Because number one, it signifies cash. Number two, when you have got cash, some of them can choose to invest. And that's where you get your capital gains. Because if the stock is the type where the business model is like, ayo, so hard to get cash. It's like every day you have to chase customer for money one. Then very hard to invest. Because every day, every now and then they need to keep on raising cash to stay alive. Then no point also lah. Okay, so dividend yield is calculated as follows. You take 29.3 cents for stock A, you divide it by 5 ringgit 85 cents, and therefore you have a dividend yield of 5.01%. Stock B is like this, 7.2 cents, you divide it by 2 ringgit 89 cents, and therefore your dividend yield is 2 ringgit 49 cents. Alright, so Smita, so far okay, right?
Okay.
Okay lah, alright.
All good.
All good, huh? So usually, why is this under valuation? Very simple. Because for me, if I see that a stock is actually giving out a good dividend yield, that means it's cheap and more undervalued. If the stock is not giving very high returns in terms of dividend yield, then it's more expensive and it's deemed to be overvalued for me.
Okay.
Okay, but what is the benchmark? What's the minimum? What's the maximum? Okay, so usually I have this rule called the 3% to the 5% rule. Why 3%? Because in Malaysia, bank FD give how many percent FD? 3%, right? So without taking any risk, you're getting 3%, right? So if you want to invest into something, then you're taking risk, right?
Yeah.
So since you're taking some risk, you are going for it, you might as well aim for higher thing lah. Higher 3%, more than 3% returns lah, in cash returns. Okay, so that's why the minimum is 3%. So if you ask me, hey Ian, can buy this stock? How much the dividend yield? 0.5%. Say, what for? Put it in the bank. Okay, yeah. So that is the logic behind it. Okay, so with that we covered the second part. Now let's get into something really, really exciting. How do you value a stock like a pro? Okay, so this is very important. Now, just now, maybe some of you say, "Aya, Ian, this one basic stuff lah." So, webinar regular. Now, I'm going to give you two real stocks. All right, stock A and stock B. Just now, all these are fictitious for beginners to learn, but now this is the one. The two stocks are actually real. Okay, later I'll reveal their identity. Now let's go back to 2015. All right, I purposely do that. Stock A at that time, at 2015, year 2015, which is like 3-4 years ago, the price is 11 ringgit and 70 cents. Stock B, the price is 3 ringgit and 33 cents. For stock A, the earnings is 72 cents, the dividend is 71 cents. Okay. For stock B, the earnings is 26.9 cents and the dividend is 21.5 cents. Now, as stated before, all these data are extracted from the actual annual reports of stock A and stock B for the financial year 2015. Now, I'm going to give you a little bit of time because there are two calculations that you may want to calculate. Which of the two would you invest? All right.
Okay, people have already started answering, and they're answering stock B.
Okay, one of them has a lot of comment. What did he say?
B is better for long term. A has DPR of almost 100%. No more money for reinvestment. B has reserve for investment.
Okay. Okay, that's also logical. All right. So what else? Invest in both. Okay.
The next comment, stock B, dividend higher and earnings higher.
Okay. So, okay, so for most people, they are actually answering stock B lah.
Someone has answered stock A.
Okay. All right. So I would say, out of 10 people, 8 will say B over A. Right? Okay. So let's review their identity. Okay. Now, in a glance, I believe this is what you have calculated. All right. In a glance, we find that stock A, all right, the PE ratio is 16.25. And then for stock B, the PE ratio is 12.38, right? So in a glance, we can say, stock B seems to be cheaper than stock A, right? Because one is at 12, one is 16, what? Yeah. Might as well go for 12. Logical. Now let's look at dividends. Now when it comes to dividends, stock A actually not bad lah. You know, dividend yield is 6%, double the FD rate. But stock B, wow, 6.46 eh. All right, it's a bit more than stock A, somewhat cheaper. PE ratio somewhat cheaper. And not only that, look at the price itself, more affordable. 3 ringgit only ma. Right now.
Yeah.
Now let's jump back to 2019. Let's review. Let's see what will your investment returns be. Okay. Now fast forward to May 2019. Here are your results. Okay. For stock A, for those of you who choose stock A, it went from 11 ringgit and 70 cents. That's your purchase price. Today, that stock is trading at 25 ringgit and 42 cents. So you have a capital appreciation of 117.3%. Wow, right? Seems like more than double your capital war. Then in the 3 years, you have actually collected 2 ringgit and 50 cents in dividends. So therefore, in that 3 years, your dividend yield is about 21.4% lah. So all in all, your return for that 3 years is about 138.7%. Hey, not bad lah. For if you choose stock A, congratulations. But let's look at stock B. Stock B has lost money a bit. The price has actually dropped from 3 ringgit and 33 cents to 2 ringgit and 50 cents. So it's a capital loss of 25%. But hey, it's dividend yielding 49 cents more. All right, so you're getting 14.7%, which means you are losing just 10% lah in that 3 years period. All right. So of course, you may be saying, why like that one? All right. I thought I choose this. I'm doing the right thing. What Ian say? How come stock A make money, stock B don't? Actually, there are a lot of wisdom behind it. Okay.
Okay.
Now the first one is this: even if you invest in stock B, because you think that it's because dividend, you won't lose that much because at least you're getting some cash. So it will offset some of your capital loss lah. Because if you purely go for capital gain all the time, you're like addicted to that capital gain, and then you forget about dividend yield. Then if it's a loss, then it's loss lah. No way to recover already. Bye bye lah. Yeah, that goes your money lah. All right. So that is the first wisdom, first gem of wisdom. Now, as for the second reason, which is the ultimate, the ultimate reason, I have to do a live demonstration lah.
Okay.
So with that, I have to actually look at my spreadsheet.
Okay.
So let's go to my spreadsheet. I'm going to show you. Okay. So you guys can actually see, right? My Google spreadsheet, which is stock A and stock B. And by the way, stock B is not the star, and stock B is also not Asia. Okay. Now, as you can see from stock A, here's what I'd like to point out, yeah? Okay. So this is the earnings per share. Can you see that this is 2015? And I have actually compiled the earnings per share for the past 10 years. Purposely. So for me, as an investor, it's very important for me. I'm not too sure for you lah, but for me, I have this habit of compiling 10 years worth of 10 years track record of a company's earnings per share. It's very important.
Okay.
All right, because if you see here, from 28 cents, it actually grew. No negative. It means 10 straight years of profit, 10 straight years of stable growth, or at least 7 or 9 years lah. All right. Maybe one of the year it dropped a bit, but don't be so leceh lah. So like, but overall in that 10 years period, it must be like in a straight line. At least that's the first quality.
Okay.
Okay. Of course, yes, I will do that's the first criteria. When it comes to quarterly, because got experience already, some will ask, hey, what about the quarterly? Need to see or not? Usually quarterly I also see, all right? So for my own subscribers, I will actually compile like 20 quarters. So I can see the pattern, okay? So usually I see all these things for a reason. I want to check out the pattern, whether or not it's profitable and whether or not it's consistently profitable.
Okay.
That is the first criteria. So stock A has actually passed this criteria, okay? Now let's look at stock B. Now, when it comes to stock B, can you see here? It's 10 years of profitability. Yes, no negative, but got profit, right? But then it went from 37.9 cents, and every year it actually declined. It seems like either it's not increasing, or it's actually like a bit like decline. Getting lower. So I'm gonna give you like 5 seconds to actually think about it lah. Look at the figures. It's actually on the declining trend. Okay, so this is very important. The first thing when it comes to valuation is that you cannot just do on a single year basis. It has to be on a 10-year basis. Okay, now if you see this particular stock, and I compiled the stock price for the past 10 years lah. This one you can get it from Google. This one you can get it from the annual reports of the company lah. All right. Now as you can see, I always like to compare the 10-year performance of a stock price with the 10-year profit performance. There's always a reason why one, because after you look at a lot of stocks lah, all right, you tend to have this conclusion. In that 10 years, if the company has consistent growth in profits, usually the stock price will be good one.
Okay.
Growth in profits always lead to growth in stock price. Okay. Declining in profits, like what you see right now, always lead to declining stock prices. All right. So if I go back to stock A, you can see the stock price performance lah. All right. It went up from 5 ringgit to 11 ringgit.
Yeah.
Okay. It's actually that simple. But in that 10 years period, although growth in profits lead to growth in prices, sometimes you get good news one, because not all people who buy stocks are value investors. Some of them they are very short term one. All right. So whenever there's a hot market, maybe people say, "Hey, Bismillah, buy lah." They say, "Really? Can buy? Buy all." All right. There will be times like that one. When that happens, it will cause the stock price to actually go up. Then it's more and more expensive. Actually, at that time, we will be willing to sell to Smita lah. So then we say bye-bye lah. Okay. But how do we know that kind of thing happened? So we calculate PE ratio lah. You see the PE ratio, we calculate it for the past 10 years. So if I look at for the past 10 years, the PE ratio, right? See, Google spreadsheet, very good. It gives us the average. So the average is 16.96, right? So let me just put it down here, 16.96. That's the average lah. Okay. And then I compare it with today's 16.25. So 16.25 is the current PE ratio, and then the 10-year average is 16.96. If the current is low, here's the thing. If the current PE ratio is lower than the 10-year average, good sign. Very good. Okay?
Okay.
Because it means it's cheaper than its average. Very good. Okay? So for stock B, you can actually do the same lah. But usually I won't do. Because I only invest in companies that grow profits consistently. Alright?
Okay.
Because if that criteria is not met, then PE ratio is actually meaningless lah. But if you can see here, the PE ratio is 13.65. So, and the current is 12.17. So stock B is also trading at below its average, which is okay, but the quality part not there, you see. So sometimes stock valuation is always, you have to look at multiple angles.
Okay.
Now you can also do the same for dividend yield. Now let's look at dividend yield. The 10-year average is actually 4.99, right? So let's put a note here, 4.99%. And the current is actually 6.07%. Very good sign. It means what, your current dividend yield, if you buy now, is more than your average. Very good. It's like usually this place, the property market is 500,000. That's the bank value. Now you're getting it at 400,000. Wow, okay lo, good lah. That's what it means lah.
Okay.
Whereas for stock B, of course the average is 7.88%. because the dividend has been declining anyway. And then its current is 6.57%. All right. So therefore, the dividend yield is below its average. So it's not exactly a good thing lah.
Okay.
Okay. So with that, let's move back to my slide. I'm gonna wrap this up with a few gems of wisdom. Okay.
Okay.
So let's continue. Oh, we have to. Let's speed. Let's do a bit of speed clicking here. Okay, here's the summary of my presentation today. So if you are new to investing or you have been investing for a long time, maybe these are some of the key takeaway points lah, to help you to become a much better investor. This is from my own personal sharing. The first one is, if you don't have a system, have a system. Very important. Okay, so for me, step number one is always to assess the quality. Actually, I'm supposed to review who are the stocks. Never mind, later I will do after the summary. Sorry about that. Okay, I'll review to you, all right? For those of you who are thinking, sure or not, real stock or not. But anyway, step one, like just now, stock A and stock B, we always need to assess the quality of the stock first, all right? Because if the quality means the profits got grow or not. If got grow, good. That's one of the key qualities. If the profit is declining all the time, no good. Bad quality. Bad quality means forget about valuation lah. From the good, do valuation. A lot of people they tend not to follow this order. They don't see quality first, then valuation.
Okay.
What that means is that they go to the market. Fishmonger A has good fish. You see, wow, very delicious. Fishmonger B, fish not so good, but then very cheap. Fish about to be rotten one.
Oh, okay.
All right. So for a rotten fish, how much will you pay for a rotten fish later?
I don't think I won't buy the rotten fish.
Yeah, that's exactly it. So when you buy fish, right, you always buy the good ones that you want to makan, right? Then only you bargain for the price, right?
Yeah.
For rotten fish, you want to bargain for what, right?
Yeah.
That's exactly the point. Okay. The third one is just now from the first question. Stock A 1 ringgit, stock B 10 ringgit. Okay, which one is cheaper? All right. So here the lesson is do valuation. What's affordable? 1 ringgit is more affordable than 10, but it may not be cheaper. Do valuation. The fourth one is always compare its current valuation against its 10-year average. That's for stock itself. Oops. Okay. Don't do current only. It's very misleading. Like just now, a lot of people do B. Yeah. All right. It's not to say it's a mistake. I intended it to be a mistake anyway. I purposely find this to actually share with you that you should do 10 years average. And the fifth one is, like for example, sometimes we have stocks like, okay, Public Bank, CIB Bank, Maybank. Which one is better? So you have to compare it with its peers. Like Rubber Glove, Hatta Lega, Kosan, Top Glove, which one is better? Compare lah. Do the assess quality valuation, then you find which is the best for you. Okay. Okay, with that, I have actually counted my session apart from revealing who is stock A and who is stock B. Do I want to do that or should I actually do that?
Do you want to do?
Yeah, let's do that. Then we can get into the Q&A lah.
Okay.
How do I get the spreadsheet? So let me review to you, then we will answer all your questions. Thank you so much for your patience and for your assistance and your attentiveness. Very important. So here we go. Stock B. Berjaya Sports Toto. All right. So this is actually stock B. It's actually quite well known in the market to be a dividend stock. All right, but yeah. Decline in profits means decline in stock prices. Any guesses for stock A? I'm going to review to you now. Stock A is Carlsberg.
Yeah. Someone actually answered Carlsberg.
Maybe he's an investor. All right. Okay. So with that, thank you so much, Smita, for having me.
Thank you. Okay. So now we are going on to the Q&A session. So please place your questions in the comment box, and we already have a few questions. So I will start asking that questions first.
Okay, I got all the time. Okay, let's
Okay,
get it.
now that everything is moving fast, do we still look into 10 years? Many companies are new companies for few years, etc.
Okay, it depends on what you're investing for, lah. All right. The reason why I go with 10 years is because, um, in the 10 years period, lah, a lot of things can happen. Economic booms, economic busts, right? Okay, let's say for example, we can have government changes from BN to Pakatan, right?
Yeah.
It can happen in 10 years. Or you have the US-China trade war. You have everything in 10 years. So why 10 years? Because it's a test. You want the company, right, to be resilient in all economic and political changes. Every climate also profit on.
Okay.
So that is why I look at 10 years. I'm not too sure about you. All right. But the danger is, for me, if you look at 3 years only. Okay. So let's say, for example, in 2014, okay, last time I can recall, all right, there are so many government projects, like construction projects, like MRT, LRTs, everything come.
Yeah.
Then all the construction company, wow, get all the order books and stuff like that, and then their profits are all shooting up, right? Then you only look at the 3 years. Now government change, then a lot of uncertainty, don't know what happened to your MRT and all this kind of stuff, don't know, and then everyone also don't know. Then nobody want to invest already. Then the stock price also jump, also slump. Then the profit also slump. Okay, so that means to say we cannot look at 3 years only.
Okay.
It is actually meant for that purpose.
Okay, so we have another question here. How do you evaluate new IPO stock?
Usually I don't evaluate new IPO stock, all right? Because here's the thing. The reason why I compare not just the profit of the company, but also with the 10-year price performance, because I want certainty, okay? For IPO, there's no reference. Means is it because the stocks are not traded. So when they are not traded, we won't know.
Yeah.
We will not know who is going to buy, who is not going to buy, and stuff like that. So like for example, like let's say bigger caps. Let's say for example, not to mention stocks, but anything beyond $1 billion lah. All right, in 100% shareholdings of market cap. All right, they are owned by pension funds, financial institutions. Now these are all very stable investors, and they want cash returns. So they are very appreciative of stability. So with them around, then of course your investment will be more stable lah, because you don't have speculators suddenly like go in, come out, go in, come out. Then your stock price also yo-yo all the time. So I don't want that with my investment. So it depends on whether you want that for your investment or not lah. All right.
Okay. Then the next question is, how should we look at valuation expansion? For instance, in situation of Harta, Nestle, QL, which have PE of more than 40.
It depends on. For me, actually for my own portfolio, I never had anything beyond 20 lah. So so because I mean to say, it depends why you want to get into that. All right. So like for example, everything is about if we are talking about stock valuation, value investing, all right. So you may buy let's say a property. Let's find a very good location. Let's say Mont Kiara lah. Okay. Now let's use the audience. Now I've got this 1,000 square foot property apartment. Okay. And Smita, I'm gonna sell you at 1 million. Will you take it? $1 million to buy a 1,000 square foot property?
No.
No, why not? Okay, let's say if it's per square foot basis, 1 million divided by 1,000, it's about 1,000 per square foot lah, right? So let's assume that around there, the per square foot, you find all kinds of projects within the vicinity. It's also 1,000 lah. Okay, will you buy?
Yeah.
Maybe lah.
Maybe.
Because you think it's a fair deal, right? But what? Because Mont Kiara so prestigious, and then all the property looks so nice. Oh, So your assets quality not bad lah.
Yeah.
And then your per square foot price is 1,000, which is comparable with other people. So okay lah. Now I'm gonna say, what if the property I'm gonna sell you at 3 million? Will you buy or not?
No.
No. Why not?
Too expensive.
Because it's 3,000 per square foot. They say, what for Montiara when you're selling me KFCC price, right?
Yeah.
So it's the same principle lah when it comes to Nestle, QL, and Atalega.
Okay. Okay. So let's move on to the next question. Okay, so many questions coming in. Okay.
Let's see. Oh, there's so many.
Yeah, so many.
I just pick one.
Okay. So, okay, now, what do you think about valuation looking at cash flows?
Ideally, it's good in theory, but in practice, it's hard to achieve. All right, because different businesses will have different kind of cash flow patterns. Okay, so if you want to use cash flow, it doesn't. Okay, like for example, banks. All right, how do you assess value a bank like Maybank and Public Bank using cash flow or discounted cash flow? You can't. Why? Simple. Because every day you walk into the bank, right? You deposit money into the bank. Doesn't mean that the bank make money. It's just the daily transaction. Okay lah, I collect money from Smita. Then Smita also can say, oh, I want to withdraw. I go to the ATM and withdraw money. All right. So it's not. So that means there's like cash coming in, cash coming out, and it may not be reflective of its business performance.
Okay.
All right. So it doesn't mean that banks negative in terms of operating cash flow, so it's bad. All right. So it doesn't make sense if you want to use this on the bank. Okay. Whereas for manufacturing, sometimes you don't. Okay, sometimes you do not know. Okay, like for example, okay, there are suppliers. All right, and then your credit terms is like that, and then you change another supplier, and then the supplier give you another credit terms. All right, so it's not to say the business is not profitable. It is profitable, but because of these changes in cash patterns, then you may affect your what you call your valuation when it comes to cash flow. So for me, the cash, but then yet again, I would also like to stress that it's very important for us to look at cash flow. So for me, the general benchmark is this: I want it to have cash. Okay, positive cash flow is good enough for me. As long as it's positive cash flow, it's growing, and it allows the company to actually finance its investments or expansion plans and pay out dividends. I'm good. I mean, not too sure about what is your criteria, but to me that's good enough.
Okay.
Right.
Okay. So the next question. Okay. Okay, when we look into forward PE, we should use price divided by next 12-month EPS or next financial year EPS.
Okay, so next financial year EPS is, I do not know how they calculate. Let me say, we are now 2019, right? So for those of you who are listening, forward PE ratio means to say you're trying to project what's going to happen next year lah. Okay, so it's like Smita and I run a business, and then we say, this year we make about 1.5 million, Smita. So next year I think we can make 2 million lah. But did we make 2 million? Haven't you, right? Isn't it? Because it's something that we think and expect for the next year. So if you want to use the figure, it's also okay lah. But for me, I don't do that lah. I only use the actual one because the actual one is like it's more realistic to me lah. It's like property. Think about it lah. It's like let's say you have a property sub-sale market, and then you say, which one do you think is more certain for you, Asmita? Property, yeah. Secondary market, existed one, got tenants. Then you ask, how much are you paying for your rental of 2,000 a month? Second property, haven't constructed. the selling agent say, oh, once it's completed, you can actually rent out the rooms and then you get 2,500 a month.
Okay.
Okay, which of the two do you think has more certainty?
The sub-sale property.
Yeah, that's why.
Okay, so the next question is, how about the type of business the company is doing? Is it one of a big factor in choosing good stocks?
Yes, it's a very big part. Because whether or not you it doesn't matter how you view it lah. For me, when you buy into a business, when you buy a stock, it means you're putting capital into a business. So it's best that you invest with the mindset of owning a business, not playing with shares and just merely gambling. Yeah.
Okay, so the next question, do you think the construction company is undervalued now? The whole construction stock PE and PB is considered 8 to 10 years low.
Okay, there are many construction companies where their share price has actually dropped, right? And then of course their PE ratio now looks very nice. Now the question is this: the reason why we look at business model is this. For construction companies, you see, it's unique because for it to be continuously profitable, because for me it's a very big word, it has to be continuously profitable for the past 10 years. Not many construction-based companies can achieve that. That's number one. You have to look back at the 10 years. After that, you say, I don't want already. All right? But do your homework, right? Do the 10 years thing. Okay? Now, the second thing is what's going to happen in the future? Because construction companies tend to make money out of contracts, like MRT contracts, LRT contracts, highway building contracts, or they want to build new buildings and then got contract. Okay, so what happens after the contract expires? It's like this lah, like property development, right? Let's say small scale property development. You say, okay, me and Smita, we get into a business where we're going to build this building. It's going to cost us. The contract is worth 200 million. And we have to build it in 3 years. So we work very hard, we build the building for 3 years, and then after 3 years we get the 200,000, then we didn't secure any other contract. He says, Smita, what are we going to do next? Don't know, no contract. Then we have to find contract. Then during this period, how?
Yeah.
No more profit, right? Yeah, then your share price drop lah. So it's very dependent on what the construction stock has in hand when it comes to contracts. Very important factor. So you may want to look into that if you are interested in construction stocks.
Okay. So the next question. Okay. The stock price that used for evaluation for the example stock A or B for the past 10 years is the highest or lowest or average price for the year?
It's the end price. Means to say, if the end is 31st December, it's 31st December. All right, so it's not the highest, nor the lowest, nor the average. It's the end price of that financial year. All right,
okay.
Thanks.
So in the Excel sheet, there were other parameters such as DPS and market cap. What are those and how does it affect your evaluation?
Okay, DPS is just dividends per share. Okay, that one very important to me. Is everything lah. So you use that as well. EPS and DPS, you use it. For me, I use it side by side. Okay, and market cap is not exactly a factor. Market cap, the definition is very simple. Okay, so let's say for example, market cap means, let's say Maybank lah. All right. If you want, Smita, if you want to buy the entire Maybank or the banking empire, how much do you think is the price tag of the entire banking empire of Maybank? Just guess a figure lah. Don't know. It's actually 100 billion.
Wow.
Ringgit. 100 billion. Do we have the money to buy?
No.
So therefore the shares are split right into, let's say 10 billion. Okay, let's say 10 billion shares lah. Okay, so you take 100 billion, we divide it by, we chop it down into 10 billion, slice a cake, and then everyone gets a share lah, of $10. All right, so it's something like that. So market cap means 100 billion. Okay, so it is actually calculated like this: the share price multiplied by the number of shares. That's it.
Okay. Then the next question: which reference date should be the stock price for the valuation analysis?
The financial year end lah.
Financial year end.
All right, but this one it depends how detailed you want. It depends how detailed you want to be lah. Maybe some people they do it on a daily basis or monthly basis. That one is up to you lah. But then to me, it's not efficient anymore lah. Because you are overly concerned about the analysis. Although it's good. Don't get me wrong. It's good to be as detailed as possible, but it's not so efficient in terms of time management lah. Because we are all busy working individuals and or self-employed people and stuff like that.
Okay, so the next question is enterprise value another kind of valuation?
Yes, okay, but I don't use it because the calculation is a bit complicated. That's number one. Okay, some stocks do that kind of valuation, the enterprise value. But the thing is, not every stock does that for you. So when you have 900 stocks and then you want to do peer-to-peer comparison, and then a handful of stocks will do the enterprise value, the EV. Most of them don't do EV. How are you going to compare? You're going to be sitting down there trying to calculate, and it's going to be very time consuming. So I don't do that.
Okay. So we still got a lot of questions coming in.
Am I just feel?
Okay. Is there any other important ratios to look into since there are too many ratios?
It's just 4. Master that 4, you should be good enough. I mean, of course there are price to revenue ratio, price to cash flow ratio, price to this ratio, price to that ratio. You have too many ratios, later you go, so no need lah. I mean, you have 4. I mean, to me, 4 is more than enough. All right, it's actually something like martial arts lah, you know. Like Chinese Kung Fu, they have too much, sorry to say lah, too much gaya or something like that lah. But then in actual combat, you may not use every single gaya. All right. Whereas for, let's say, Muay Thai or something like that, you only have a few punches here and there. But then they practice it like 10,000 times. So if they want to do a jab and cross, they might practice that 100,000 of times. That is even better than learning 100,000 of gaya, but little practice. Yeah.
Okay. So the next question: if let's say I want to invest in a big company and have done the valuation and the dividend is good, but because of the current economy and the company's dividend decline, what does that affect me?
Oh, that one is very subjective. Okay. The reason why we do 10 years is simply because we want it to be resilient in every single market condition. So the idea, so for me, I am in favor of this kind of technique when it comes to building portfolios, which is all-weather portfolio. Means good time, bad time, the portfolio must make money and it must be safe and sustainable. Okay, so when you have access of business and then you find that it's good, the valuation makes sense, it's cheap, and then the economy is bad. Actually, when the economy is bad, the valuation is supposed to be attractive because not many people are willing to invest. So actually, it's a good time to pick up stocks. So I think it's okay.
Okay, so okay, another question.
Yep.
Okay, so when you calculate the PE past year, are you using current price over the EPS for that particular year or using the close price on the financial year over EPS?
Close price.
Okay. So another question, will you compare with a way of different industry stock or similar industry stock to invest?
Similar lah, peer to peer lah, apple to apple. Okay, that one is very important lah. You can't compare. Let's say for example, a REIT with a bank doesn't work. Okay, so you have to do it peer by peer lah. Plantation means plantation. Manufacturing means manufacturing. All right, so do peer to peer comparison. It's more meaningful that way lah. Okay, but beyond that, I think it's actually very important for you to understand your objective of investing. Okay, so for me, I'm more of a dividend guy, as introduced lah. Okay, so for me, that's my game lah at this point of time. So usually, that's where you build your watch list, and then therefore you will actually play around with that particular game. So know your objective is very important.
Okay, so since we're running out of time, so we'll just take the last question.
Okay.
For REITs, is there any other valuation metrics that we should look at?
REITs ah. Okay, REITs usually I don't do PE ratio. Okay, because REITs for PE ratio it will be very low. All right, simply because they value their properties every single year. Okay, like for example Sunway Pyramid. All right, it's owned by Sunway REIT. Every year sure got valuation. Every year the price increase. All right, year by year the shopping mall appreciate in price, property price. So and they will factor that into the current year's earnings. It will jack up the earnings. Therefore your PE ratio will be very low. Okay, so therefore I don't do that. All right, for me what is more realistic is to calculate its distribution.
Okay.
Why? Because capital appreciation of a property is not cash. It's just on paper. It's like your house appreciate from 1 million to 1.2. Yay! But it doesn't. But then if you don't do anything, you don't refinance your property, you don't do nothing to your property, it's just on paper lah. All right. So the more important thing is the rental income. So every now and then you can actually collect the distribution. If it's a REIT, of course for property is rental lah. All right. So therefore from there you calculate your returns. So therefore I will use the distribution yield a lot when it comes to that. And at the same time I will use PB ratio, because for me property means the business model is recurring, because property you can keep on renting for selama-lamanya lah. It depends on what actually this one also very important. Different REITs will have different kind of characteristics. Okay, let me explain.
Okay.
The first one is actually the longer term one is actually hospital. All right, you can buy some REITs, they just own hospital. So when they do that, let's say Sunway Hospital lah, when they sign the agreement, they say okay, we're gonna lease the property for the next 10 years. All right, other hospitals can be 15 years. All right, and for the next 15 years, that REIT is going to make money. It's going to make rental income from that hospital on the incremental bit. Every year the rent will go up one for the next 15 years. All right, so that means it's a super safe, resilient business model, and you can actually use PB ratio on that.
Okay.
Whereas some, let's say like hotel, then of course can also lah, but then hotel means, because hotel usually the arrangement is a bit different lah. Because hotel is like they have a base rent, and then it depends on the hotel sales. If the hotel is doing well, then you get more. If the hotel is not doing as well, then you get lesser. All right. So there's different place. All right. But still, I'll use both lah. Okay. So REIT is actually something that I think I'm also quite okay with lah. So yeah, well, that's why I say mention a little bit more lah.
Okay. Okay. So that's the end of our questions.
Okay.
And thank you so much, Ian.
No, thank you so much, Peter.
Okay, so just let you guys know about the next webinar. So the next webinar will be the science of buying and the art of selling. So the date will be 3rd of June 2019. It will be 8:30 p.m. to 10 p.m.
Mhm.
And here's the link to register for the webinar. So I will drop the link here in the chat box. Okay, that's the registration link. And with that, we come to an end of our webinar. Thank you so much, everyone, for being a very good participant and asking all your questions. Thank you so much for your time. And of course, thank you, Mr. Ian Tai.
Thank you.
So if the participants want to get in touch with you, they can email you, right?
Yeah, just email me lah. All right, that's the fastest way.
Yeah, okay. So thank you so much, everyone, again. And okay, I just have a comment that no registration link can be seen. The registration link is in the chat box. Can you please see the chat box? And then you'll see the registration link. Okay, so with that again, thank you so much. Thank you, Ian.
All right, thank you. You're welcome.
And thank you so much for joining our webinar tonight.
All right.